Welcome. My name is Evan Unzelman. I am the CEO of CRT Experts, and thank you for joining us today for a discussion about using charitable remainder trusts as stretch IRA substitutes. We are recording the webinar for all of our live participants. I'll get an email out sometime tomorrow, and that will have a link where you can watch the webinar, parts of it, forward it to colleagues, etc. Just here at the outset, just a lay of the land, so to speak, what we'll talk about here today. Of course, we're all aware that the Secure Act has effectively ended the stretch IRA. And today we're going to talk about how to use or replace that stretch using a charitable remainder trust. We'll talk about the basics, how it works, when and how it's implemented, who's a fit, who's not a fit, etc. But we'll also go beyond the basics and talk about, once we've decided, yes, we'd like to use a CRT to replace the stretch, how do we design that CRT? And then that's of course getting into the bailiwick for us here at CRT Experts. We'll talk about, and we'll see that all CRTs are not created equal. We'll talk about how to best design the CRT so it's maximizing the flexibility and accomplishing what that IRA owner wants to accomplish with respect to the flexibility that they're giving the future income beneficiaries of the CRT. Hopefully, most of you are familiar with CRT Experts. CRTs are all we do, hence the name. For several of us here at CRT Experts, we have spent our entire professional lives working with charitable remainder trusts. For me personally, in the early 2000s, I was tasked with developing a secondary market for the income interests in charitable remainder trusts. It's a topic for another day, another webinar, but the income interest in a CRT is a capital asset. And just like other capital assets, it can be bought and sold, can be contributed to a new CRT for heirs, can be given to charity. And that's where I've spent a lot of my career working with charitable remainder trusts, those techniques which we call secondary planning option, working with CRTs that are at the complete opposite end of the life cycle that we're talking about today. Today, we're going to be talking about setting up or putting in place CRTs that will be funded upon the IRA owner's death, even pre-CRT life cycle. Secondary planning is at the very end of that life cycle where the income beneficiaries just don't need the income anymore. They want to make some changes, and we can help them exit the trust in whatever way is most efficient for them. We run the gamut in terms of CRT services here. We work through advisors, but we work a lot on the front end with attorneys, trust and estate attorneys on designing CRTs. We administer CRTs, particularly more complex arrangements. We'll talk about those later in the presentation. And then secondary planning, sales, and rollovers of CRT income interests. Ultimately, we're a one-stop solution for advisors when it comes to their clients' CRT needs. And that's what we want to be. We want to be the first call when you think of or encounter a CRT situation. Headquartered here in Leesburg, Virginia, just outside of DC. Okay, so we're here today to talk about this problem, and that, of course, is that the Secure Act has ended the stretch IRA. So instead of beneficiaries being able to withdraw that income over their remaining lifetimes, they must withdraw it over 10 years. And of course, those distributions are going to be taxed at the highest applicable rates. So, whether you want to call it a tax disaster, it's effectively a large tax on the IRA after the death of the IRA owner. But however you want to describe it, for many clients, particularly those who had planned on their IRAs distributing over their lifetimes of their children, this creates a problem. Fortunately, though, with a charitable remainder trust, we really have a pretty natural solution. So when we think about what drives the IRA or the value of an IRA, at the core of it is tax efficiency. We're investing tax-free dollars in a tax-free account. And even though the Secure Act ended the stretch IRA so that those distributions can't be stretched beyond 10 years anymore, we can replace it with the charitable remainder trust. The CRT is an exempt trust. It's tax-free, just like an IRA. So on the IRA's owner, the full value can go into the CRT with no income tax. And like the IRA, the CRT is able to grow those assets tax-free. The investment advisor has the benefit of no tax drag on the investments moving forward while they're in the exempt charitable remainder trust. We'll talk about deferral later in the presentation, and that will even further augment that tax-free compounding that can occur early in the life of the CRT and enhance future distributions. Like the IRA, the distributions to the CRT beneficiaries are taxable. That's where tax is coming into the equation, is when that CRT is distributing income to the beneficiaries. Unlike an IRA, though, a CRT is eventually able to distribute capital gain. I say eventually. In this context, where it's an IRA retirement plan funding the CRT, that is going to create a large slug of ordinary income that has to be distributed out first. So for those of you who are familiar with the way that CRT income is taxed, it's taxed according to a four-tier accounting structure. It's taxed on a worst in, first out basis. So any ordinary income that the trust earns has to be distributed out first. So unlike most CRTs, the traditional CRT, when it's created, it's funded with a capital asset. So it's deferring capital gain. In this case, that's ordinary income. We need to go through all of that ordinary income before we can then start to distribute capital gain. In most cases, that's 15 to 20 years out. In terms of when that ordinary income, we've burned through it, and we can then start to distribute the capital gain. But it's able to distribute capital gain, and that's unlike even the old stretch IRA, where it's all going to be ordinary income. So even compared to that old stretch IRA, which of course isn't possible anymore, there's some tax advantages, tax benefits down the road with using a charitable remainder trust when it comes to how those distributions are taxed when they're distributed to the IRA owner's heirs. In terms of the tax and legal, you can see here up on the screen in the 1990s, there were several private letter rulings that confirmed a qualified trust like a CRT can be the beneficiary of a qualified plan. And of course, we know that once those assets are inside of the CRT is exempt from tax. So what we've been able to do here is restore the stretch. The CRT is preserving the pre-tax dollars in a tax-free account. The trust is growing tax-free under Section 664. And ultimately, the heirs are going to get significantly more money. We'll look at an example here in a bit to see how much more, but it doesn't take a rocket scientist to figure out, well, if you preserve the IRA, that's a tax-free account. We move the assets into a CRT, which is also exempt, and put a lifetime income stream on it. That's going to be taking all that income inside of a tax or 10-year window and getting hammered on the taxation when the IRA assets are distributed inside that 10-year window. So it's not. I'll say this: we would do a lot more of this planning if this decision was made purely through the after-tax value lens. It's just not a fair comparison. And it's just, in many cases, the client is just okay with the kids getting those assets inside of that 10-year window, effectively getting immediate access to all that income, regardless of the tax consequences. That client, of course, wasn't going to do the old stretch IRA. They're probably not going to be interested in using the CRT. Now, we can point out the other benefits you can see up here on the screen, from asset protection to using multiple generations. It's simple to implement, but ultimately the clients where this makes sense, these are typically your tax sensitive clients who in many cases were already planning to use that old stretch IRA before the Secure Act ended it. So in terms of where it's a fit, where it's not a fit, because we're using a CRT, which requires trust administration. This is a standalone entity with a tax return. There is a size threshold that we need to meet. It's not a black and white number. We would generally say 500,000 and up, even $1 million and up, before we would start to really recommend looking at using the CRT to replace the stretch. There, you could certainly set up a CRT with less than $500,000 in assets. In our experience, though, we look at a lot of existing CRTs that have been in place for a long time. When those CRTs get smaller, you have $100,000 in a CRT and you're paying couple $1,000 a year for the administration. It's also at distributing 5% or more a year. What happens is that administrative burden cost is just too large relative to $100,000 in a CRT. So if we've got $500,000 to $1 million and up, this planning certainly, from that standpoint, from a size standpoint, certainly makes sense. Of course, we're going to be looking at this as clients get older, typically 50 and older. And again, these are more often going to be your tax sensitive clients who are concerned about this tax disaster when their kids have to pull all that income inside of that 10-year window. Where it's not a fit, of course, clients who are going to spend most or all of their retirement plan during their remaining lifetimes, they're not going to be a fit. And the client that I mentioned on the prior slide, that's just, they're okay with their heirs getting all that money quickly upon death. They're just not concerned about the tax consequences. So if it's a fit, how do we implement the planning? Before we jump into the implementation, just a couple of quick things to point out. This has to be implemented during the IRA owner's lifetime. I think in many ways this is helpful if, as I'm sure many or all of you who are listening or watching have experienced, one of the key hurdles to getting the client to pull the trigger on any type of planning, but certainly charitable planning, is inertia. It's really easy to kick the can. We can't do that here. This has to be implemented during the client's lifetime. We can do this, and it typically is implemented on a revocable basis until death, but we have to put the structure in place during the client's lifetime. Second point, and this will bridge us into the back half of the presentation, CRT design matters. We need to make sure, just like when we're creating any CRT in any context, that we're implementing all the flexibility the donor wants implemented. So how do we implement this planning? There are generally three ways we can do it. You can use a funded trust, an unfunded trust, or most commonly a testamentary trust. In each of these cases, the result is the same. The trust is named the beneficiary of the IRA. So we're going to go to the custodian of the IRA, fill out a change of beneficiary form, and name the trustee of the CRT as the beneficiary of the IRA. It would defeat the purpose of the planning to put the planning in place and not change. We have to actually go to the custodian and change that beneficiary. So let's talk about these three ways. With a funded CRT, and this can be an existing CRT, as long as it has the right language. Most CRTs allow for future contributions. CRTs will allow for future contributions. So as long as that language is in there, that trust can be named the beneficiary. That existing trust can be named the beneficiary of the IRA. Why don't we see that? The reason is that existing trust is typically not structured the way that it needs to be structured in the stretch replacement context. Namely, usually the kids and or grandkids are not beneficiaries. If we happen to have the CRT that's already in existence and it's structured just how we would structure it in the stretch replacement context, we've got what we need. We just need to name that CRT as a beneficiary. Just uncommon to already have that structure in place. Unfunded CRTs, we don't see these a lot, but it is an option. So we can create a CRT and fund it nominally. And these are qualified trusts as far as state statute, but under the federal statute, there's no requirement for administration. And that's what makes this doable. We couldn't afford the ongoing administration before funding if with a nominally funded CRT, but because we don't have that, we can do this through an unfunded CRT. But we we'll talk about the third option here, and that's going to make it obvious why we typically wouldn't do the second option. When we use an unfunded CRT, the effective date of the trust has occurred. So we lose a lot of that flexibility really for no reason. We can do this through a testamentary trust or will. So we're doing this on a revocable basis. You know, the trust instrument, the agreement's going to look the same, but we're doing this on a revocable basis, and that gives the donor the ability, the IRA owner, the ability to adjust that over time. For example, new grandchildren are born, or sons or daughter get married, and there's an in-law we want to include. We have the flexibility to adjust that planning over time, or if we change our mind, we can undo it over time. So doing it through a revocable trust, like the unfunded trust, there's no ongoing administration. It's just the upfront cost to implement the instrument, the planning. And then the IRA owner retains that flexibility to revoke or adjust it over time. So that's usually in practice the way that we'll typically see this implemented. So once we've made the decision, or the client's made the decision, yeah, I want to use a CRT to replace the stretch. Now we can talk about CRT design. And as we mentioned earlier, CRT design matters. We've looked at almost 10,000 CRTs here. And in many cases, we end up looking at a CRT that's no longer a fit for the client. But in a lot of cases, if there were design features available that weren't written into that trust, that if the client was made aware, they would have written into it. And so I want to go over the two top bullet points here today, which are probably, at least in our view, the most underutilized features when it comes to CRT design. But really, this extends to even basic flexibility, like trusteeship. Give the client the ability, the income recipients the ability to adjust the trustees, the charitable beneficiary. We just want we want to maintain that flexibility. Now, one thing I will say, the context is different here. So I talk about that traditional CRT creation, which is client owns appreciated property, stock, real estate, whatever. They want to defer the capital gain. They want to sell it, but defer the capital gain. But they're going to be the income beneficiaries. It's self-settled. So in that scenario, of course, if I'm setting up a CRT and I'm the income beneficiary, I want to give myself, as the trustee and the income beneficiary, maximum flexibility, of course, within Section 664. This is a different context in that we're setting this up for children. Ultimately, that income is going to go to children and or grandchildren. In some cases, the IRA owner, the donor, may not want to give the kids as much flexibility as they may have given themselves. And that's fine. We just need to know it up front so we can put those guardrails in place. So I'm going to talk, and we're going to use a case study to do this, but I'll talk throughout the rest of the presentation about these top two bullets, duration and deferral. If you're interested in a deeper dive on those, you can see the webinar right there. That is a deep dive on what we call optimized CRT design, but it's really features these two components: structuring the CRT with a maximum duration, how we're going to do that using a lives plus term structure. We'll talk about that. And then structuring the CRT for deferral. We'll talk about that as well, but we're going to talk about that fairly high level. If you want a deep dive, or if you're having trouble getting to sleep, go check that webinar out. Okay, so we're going to erect a working example here. So I want to do two things. One, we're going to look at a comparison between a family who uses a CRT to replace the stretch and a family who doesn't. Everything else is equal. So that, again, this is spoiler alert, family B is going to win. The family that's using the CRT, that's going to create a lot more after-tax wealth. But I want to at least look at the numbers. Just as importantly, we're going to use this working example here to look at these design features, duration and deferral. So you can see our families up here on the screen: $1 million, let's see how this works out. So for family B here, the first thing I want to look at is how they structured their CRT. So we'll look at who the beneficiaries are and how they set it up. So we can see here that the spouse, the IRA owner spouse, is our initial income beneficiary. They have two children. The children are the successor lifetime income beneficiaries. And then upon the last of the two children to pass, the grandchildren are the successor income beneficiaries for a fixed term of years. Technically, the shorter of their lives in a fixed term of years. In practice, unless there's significantly premature deaths, that will be that fixed term of years, just based on the actuarials. And we'll talk about this structure, lives plus term. So this is a 3-generation CRT, and it's structured as lives plus term. We have 3 lifetime income beneficiaries and 4 term beneficiaries. And we'll look at, for all of you out there, we're thinking, how does this pass the 10% test? We'll look at that here in a little bit. And we'll talk about the 10% test, because that's really what we're up against when it comes to structuring CRTs for maximum duration, stretching that CRT out as long as we can. Something I want to point out, and this is a case study actually on the other webinar I just was talking about. This isn't our family here today. This is a larger family. So, and we're asked a lot, well, what if we have 4 kids, 5 kids, whatever? What if we have everyone happens to be younger, where because of the 10% test, some of these actuarial rules about creating CRTs, we just can't qualify with one CRT. No problem. We can do the same thing. We can accomplish the same goals using, in this case, 3 different CRTs. Using 3 different CRTs, you can see here you had, this was real estate, 12 million that went equally into these 3 CRTs. This is not more complicated or more costly than using one CRT. At least it shouldn't be. If you keep that administration under one roof, it should be, from the family standpoint, there shouldn't be any difference. In many families, in fact, like this structure, because it sort of keeps each family unit, each child and their spouse and their kids, sort of as in a separate silo, so to speak. There are some mortality risk considerations. We'll talk about that later. But in some cases, that's our only choice, just because of either how many children we have, heirs we have, or people's ages. So just keep that in mind, that we're going to be looking here at one CRT for family B. We can accomplish the same thing with multiple CRTs. So those are our income beneficiaries here. And so now what we're going to look at is how do these 2 strategies compare? Using the CRT to replace the stretch versus the 10-year window. Typically, I would go graph by graph, and then I'll look at this overlay, but want to keep us on schedule. So we're going to go straight to this overlay here, and I want to walk through what we're looking at, and then, of course, the results. So we are comparing the family in red, taking that through the 10-year window, and then reinvesting and comparing that to using a CRT. So the solid green line is the value of the CRT account. That's the investment account. So it's distributing 5% each year. And each vertical green line that you can see shows that the distribution for that year. The solid red line is the IRA. So it's distributing all of its assets over the 10-year period. And then the dotted red line shows the value of the money withdrawn from the IRA after taxes and spending that's reinvested. To keep the comparison apples to apples, the heirs are spending the exact same amount in each scenario. We withdraw from the reinvested IRA account the exact same amount that the heirs receive from the CRT, and that's the vertical red lines coming from that reinvested IRA account. So as you can see, eventually under the withdraw from IRA scenario, the money's all gone, but the CRT is going to keep growing. Ultimately, it's more than double the amount of income. That immediate tax hit on the IRA is just too much for that strategy to overcome when it's put up against a CRT that's maintaining those assets, those IRA assets, in that tax-free environment. I mentioned earlier, let's see if we can get to that. There we go. So I mentioned earlier, we've got when all those assets, in this case, those $1 million are going into the CRT, that is allocated to the ordinary income tier. The first tier, it has to be distributed out. So we know that the first $1 million of income that comes out of this CRT is going to be ordinary income. But as long as the investment advisor is investing that trust for capital appreciation, which is usually the case, eventually, once we get through that $1 million of ordinary income plus any other interest, dividends, ordinary that it's earned over the years, then we can start distributing a capital gain. You can see where that's happening here, right here in year 18. And you can see that little jump there in the distributions where we've gone through all that ordinary, and now we're taking most of those distributions at the capital gain rate versus at the ordinary rate. So that's, and we'll see in the deferral, it's going to push that point out a little bit further, but that's why we see that little jump there. So I want to drill on duration first, and then we'll talk about deferral. So when we talk about duration, generally speaking, what that means is we want to extend the expected duration of the CRT as long as we can. And we want to include as many family members as we can. And so typically we like to look at 3 generations if possible. When we're doing this, what we're up against is called the 10% remainder test. And what that is, it's only a test we have to pass when we create the CRT, when we're setting the terms of the CRT. It's going to restrict the number and the age of people we can add to the trust and the payout rate. And the test is on a present value basis per an IRS formula. The IRS uses, it's a monthly interest rate called the Section 7520 interest rate. Per those assumptions and the trust payout rate, everyone's age is at least 10% on a present value basis of what goes into the trust has to be projected to go to charity. It does not mean that 10% has to go to charity as it actually plays out. This is just that test that we have to pass up front. So when we look here in a minute at family B, we're going to see how using software we figure out how, what is the absolute maximum duration that we can put on this for this particular family. We're using what's called a lives plus term structure here. So in many cases, we're asked by even really sophisticated advisors, well, you set up a CRT for someone's lifetime or for a term. You can't do both. That's incorrect. So you can see the section, the language from 664 up here on the screen, but we can structure a CRT to go for the lifetimes of these named individuals, followed by continued distributions to the shorter of the lifetimes of these other individuals and a term maximum of 20 years. So what that means, we call it lives plus term because I mentioned earlier, actuarially, the term beneficiaries, and in our case here, and usually the grandchildren, they're certainly expected to well outlive that successor term. But if for some reason, in our example here, we have 4 grandkids, if they happen to die, all of them before the term, it would be the lives. But most often, this is going to be a lives plus term structure. And this is what's going to allow us to maximize that duration. Right now, given the 75/20 rate where it is now, it's 50 to 60 years in terms of how long actuarially we can stretch out that CRT duration. So let's look here at family B and how these are calculated. So we use a couple of different versions of software here at CRT Experts. This is a software called Easy Charitable. And one of the things, I'm sure many of you know Lee Hoffman, this is his software. One of the things I really like about this software is it allows us to calculate to the day the maximum term on that successor term for, in this case, our grandkids. So we are truly getting as close as we can to that 10% test and maximizing the duration of the trust. So you can see here, we have the spouse who's 84. We have the 2 children, 59 and 56. And then we have the 4 grandkids. These grandkids are too young to be lifetime income beneficiaries. It would not even come close to passing that 10% test. So we're going to go for the spouse, and then the two children as lifetime beneficiaries, and then to the grandchildren. When we'll start the term at 20 years. Can we pass with 20 years? Given everyone's ages, we are using a 5% payout rate, as you can see here, and it did not pass at 20. So then what we do is we start to pull that term back. And as you can see, ultimately it was almost 18 years. So it can go for those 3 lifetimes, plus when the last of those 3, the spouse and the 2 children pass, it will go for another almost 18 years to the 4 grandkids. So now that we've maximized the duration of the trust, let's talk about deferral, and then we'll look at how that works out for the family as we wrap up here today. So when it comes to deferral, we're going to use what's called a net income with makeup CRT, often called a NIM CRT. I'm sure many of you are familiar. The NIM CRT will distribute the lesser of the stated payout rate and trust accounting income. So there's this net income limitation in that it's never required to pay the beneficiary more than its income. So if the trust doesn't have income, nothing has to be distributed. And we have this makeup provision that enables us to pay any unpaid or deferred amounts in future years. So that combination, the income exception and the makeup provision, can be used to control the timing of distributions from the NIM CRT to the beneficiaries. And this is all centered around trust accounting income. So trust income is a cash concept. So what that means is a trust will not have income if it does not have a cash receipt. There are several techniques to control the timing of trust receipts, and thus when a NIM CRT will have trust accounting income. But they all work the same way. The investments are held in it's often called a container. Sometimes it's a variable annuity or a partnership, but it's typically a single member LLC where all the investments are held, owned by the NIM CRT. And the single member LLC, there's some tax and administrative benefits there. That's why we typically recommend that. But all the assets are held in that container. And that's inside that, let's use an LLC here. That LLC then invests just like it would if the NIM CRT owned the portfolio directly. So we're investing in a mixed portfolio. The interest, the dividends, the realized gains that would have to be distributed if the NIM CRT owned those assets directly, if those are all inside of that container, even though that's generating that income, the income's tracked on the tax return, the 5227 for the CRT, it doesn't have to be distributed until there's a cash distribution to the NIM CRT, because that's what's triggering the accounting income, is when it has that cash receipt. So that's high level. If you go watch that webinar, if you're looking for a detailed discussion, but that's high level how we can structure a CRT, in this case, a NIM CRT, for income deferral. And no matter in any situation we're creating a CRT, any context, that's always something that we want to ask the donor, the clients. Is the ability to defer income, is that anticipated? Because we want to make sure we include that if it is, because it can significantly increase the amount of income that's distributed later on, and we'll see that. So we're going to go back to family B. Everything's the same, except we're going to assume that spouse defers income. Maybe some of you were thinking this. A lot of times in this stretch context, if we have a spouse, the IRA owner's spouse, they're in many, just given the wealth of these clients, the spouse probably doesn't want income either. So why would we put the spouse on as the initial income beneficiary? And we'll see why here, because if we put the spouse on and the spouse defers income, that's going to, we already know we're inside of that, the exempt trust. So the investment advisor, there's no tax drag, everything's compounding tax free, but now we're not even making distributions. So everything is just growing and compounding more rapidly. And what that obviously is going to do is create significantly more income for, in our case here, the children and grandchildren. So you can see here, we put the spouse was 84, so a 10-year life expectancy. We assume the spouse defers. So we've got this 10-year upfront deferral period where the trust assets are growing. Again, when there's no distributions, so we're growing up. And what that does, of course, is it augments what's eventually distributed to the children and grandchildren. Delaying the distributions at the outset just allows for those trust assets to compound more rapidly. Think of it like giving the trust sort of like a runway to take off. That early deferral just boosts that long-term value. You can see here now family B, no change to family A, but family B has gone from 3.586 million to 5.218, so about 5.2 million. So you can see how much more is distributed there just due to that upfront deferral period. As I mentioned, that is going to push. You can see our that point where we finally get through that ordinary. It's pushing that out from 18 years to looks like about 21 years there. Going to push that out a little bit, of course, because we're not taking any distributions inside that deferral period. So before we wrap up, just go back to what I was talking about earlier in terms of using multiple CRTs. Why would we want to do it? Why wouldn't we want to do it? We talked about one reason that we would, which is if we just have several children and we need to pass that 10% test. If this family had 4 children, think about that the calculations there that we looked at, that would not have passed with that same term. Might not even pass with the term at all. So what we would then need to do is start using multiple CRTs. Another reason, though, is, and this is we see this a fair amount too, is the donor anticipates this child is going to want the income. I know that. I don't think that child or these kids will. They would rather just keep deferring. If my spouse is the initial income beneficiary and she's deferring, then it's going to go down to the kids. Some may want to defer, some may not. Some may want the income. That's another reason that we would want to use multiple CRTs. We can't do that if in this case, both children are income beneficiaries of the same CRT. We can't do that. We would need to have separate CRTs. As I alluded to earlier, with separate CRTs, though, we've increased mortality risk. So now once the spouse is deceased, you only have one lifetime income beneficiary on both trusts. So there's more mortality risk, of course, than if you have both. If one dies prematurely, instead of just it continues to go because the other child is the income beneficiary, now that trust is going to end, or not end, but the term will start. So that if child 2 dies prematurely, that successor term for the grandkids will also start early. A way to hedge that or to reduce that mortality risk would be to add the in-law, the son-in-law or daughter-in-law. Now we're back to 2 lives. That's very client specific. Sometimes it's bloodline only, in which case that's just not going to be in the cards. But as long as they're favorable, they can add that in the son-in-law or daughter-in-law and keep that as a joint life after the spouse is gone. So lots of flexibility here when it comes to how we can design that CRT. But ultimately, as we put a bow on it here, what we're doing is we're using a charitable remainder trust to restore the stretch. We are maintaining those tax-free dollars in another tax-free account, moving from the retirement plan to the CRT. It has to be done during the owner's lifetime. There's different ways of doing it. We saw funded trust, unfunded, or most commonly through a testamentary trust. And then CRT design matters. And so we need to make sure that we're building in all of the flexibility that the IRA owner wants to give to those future income beneficiaries of the CRT. So hopefully this has been informative for everyone here today. Again, appreciate everyone joining us. Again, we'll get a link to a replay out tomorrow. My contact information is up on the screen. CRTs are all we do. So anytime you have any sort of a CRT question, no matter how complex, how simple, don't hesitate, because we can probably answer it on the spot. If not, we should have been able to, so we'll get you the answer. So again, thank you for joining us today. Have a great rest of the day, rest of the week, and hopefully we will hear from you sometime soon.